The Union Budget 2025 has introduced the new tax regime, which has once again brought the debate between the old and new tax regimes into focus. While the government continues to promote the new tax regime with simplified tax slabs and lower rates, the old tax regime remains attractive for many taxpayers due to their extensive exemptions and deductions. So, we are going to discuss about old tax regime, key benefits of old and the new tax regime, and key factors to consider before opting for any of those two regimes. So let's begin. The old tax regime is available to all taxpayers, including the salaried individuals, self-employed professionals, and business owners, regardless of their income tax bracket. This allows a broad range of taxpayers to benefit from exemptions and deductions under this system, making it one of the viable options for many taxpayers. Then this regime, the old one, encourages savings and investments by offering deductions from various financial instruments, enabling the taxpayers to plan finances as per the long-term goals. For those with significant investments in eligible tax saving schemes, the old regime can lead to higher savings compared to the new one despite higher tax rates. So there are various exemptions and deductions being provided under the old tax regime. For example, under Section 80C of the Income Tax Act, there are deductions of up to 1.5 lakhs for investments in instruments such as Public Provident Fund, Employee Provident Fund, and life insurance premiums. Then under the house rent allowance, there is exemption for rent paid. Under leave travel allowance, there is exemption for travel expenses. Then under the Section 24 Clause B, deductions on home loan interest payments of up to 2 lakh per year. Under Section 80 Clause D, taxpayers can claim deductions on medical insurance premiums as well for themselves, for their families and parents, with a limit of 25,000 rupees for self and family and additional 50,000 rupees for senior citizen parents. Then under Section 80 Clause E, there are deductions on interest paid for education loans, donations to charitable institutions, interest income on saving accounts, and senior citizens bank deposit. While the old tax regime offers numerous benefits, the new tax regime introduced simplified taxation with reduced rates but fewer exemptions and deductions. So every taxpayer has an option to choose between the old tax regime and the new regime. And here are some key factors to consider before making a decision. So the first factor is the income level and tax saving investments. So the old tax regime would be much more beneficial for those individuals who have substantial investments in tax saving instruments, while those who do not invest heavily in such schemes might benefit from the lower rates of new tax regime. The second factor is simplicity and compliance. So the new tax regime eliminates the need to track multiple deductions and exemptions, thus simplifying the tax calculation and compliance. So those who prefer a straightforward tax approach might find the new regime more appealing. The third is tax liability comparison. So compare your tax liabilities under the both regimes and it will help you determine which system results in greater savings for you. The fourth one is revised tax slabs under the new regime. So individuals with an income of up to 12 lakhs are exempt from paying income tax via a mix of rebates and revised tax slabs. So this makes the regime attractive for the middle income earners. And here you can see the comparison table of old tax slabs versus the new tax slabs. The fifth is marginal relief for higher earners. So the new regime offers marginal relief to those earning a bit above 12 lakhs. For example, 12 lakhs 30,000 or 12 lakhs 50,000. So it prevents sudden tax jump and makes the transition to higher tax brackets a bit smoother and pretty gradual. And the sixth one is restrictions on switching tax regimes. So if you are a taxpayer and you are a business owner, then opting old regime and then choosing again the new regime, you can shift back to new regime for only once in your lifetime. After that you cannot shift. But if you are a salaried individual, then you can shift from new to old or old to new every financial year. So business owners do not have the liberty to switch back and forth every financial year. The next one is the impact on disposable income. So the new tax regime aims at increasing disposable income by lowering the tax liabilities This will eventually benefit the middle class taxpayers who prioritize higher take home pay over the long term savings. Thus, the last one is long term financial planning. So, the old regime may be more suitable for those focused on retirement planning, saving, and tax efficient investments, while the new regime is much more attractive for those seeking immediate tax reliefs and a simplified process. With this, I hope the old versus new tax regime is clear for you guys. So take the decision wisely. Thank you.